Good morning, everyone. My name is Yao. Today, I'm going to tell you about the company Dexia, which is now known as Belfius Bank. I will tell you about the company, something more about the different ratios, why I would or would not invest in this company, and a conclusion. First, a little more about Dexia, Belfius. So, Dexia switched names in 2012 when the government bought the bank for 4 million euros. Belfius Bank is a limited company that draws its attention to local markets. The core activities of Belfius are providing credit to the public sector, giving financial services to private individuals and companies, and they also help with insurance policies. The company tries to focus on the smart ecological system based on 8 societal challenges, which are circular economy, urban development, environment, energy, education, mobility, health and prevention, smart city services. We call this Smart Belgium or a smart ecosystem. Now I'm going to start with 2 ratios based on the profitability of Belfius Bank. First, return on equity. The term indicates the ratio between the profit of the company and the capital with which this profit was achieved. The higher this ratio, the higher the profitability of the company. As you can see, the percentage evolves within the years, which is very positive for the company. Now, the return on assets. The return on assets is an indicator of how profitable a company is relative to its total assets. ROA gives a manager, an investor, or an analyst an idea as to how efficient a company's management is at using its assets to generate earnings. You can see that the percentage is raising a little more every year, which is positive for investors, but it's still a very low result. For every dollar they put into the company, they make 0.35 cents profits. Now a ratio based on the solvability of the company, the Common Equity Tier Ratio. This ratio is a capital measure that was introduced as the precautionary means to protect the economy from a financial crisis. All banks are supposed to have an average of 4.5%. Belfius Bank is doing really well with these results. The interest coverage ratio is based on the liquidity of the company. As you can see, these results are really high. Standard for this ratio is about 3 till 5. Another ratio to know the liquidity of the company is the liquidity coverage ratio, which is also very high for a company as Belfius. This refers to highly liquid assets held by financial institutions to meet short-term obligations. The most important financial sources are by commercial funding. It can be secured by business assets or alternatively can be unsecured, but this is not very popular. Now, would I invest myself? Of course I would, because the results are incredible, except for the profitability a little bit, but it wouldn't change my mind. I definitely would invest in this company. To end this presentation, I can conclude that the company is doing really well. It's profitable because of the great amount of capital they possess. It's solvable because they can protect from financial crises, and they are liquid due to the short-term obligations they can pay. Thank you.